Welcome all. Today we will see one of the important concept uh, for exams like CFA and FRM. Across levels. So these concepts are predominantly very helpful in options pricing and also to do the sensitivity analysis. I would say these are more or less like risk measures for a scenario analysis or sensitivity analysis for the option prices in either of these options like call option or put option. So these measures will be helpful in determining what is the probability that an option will be in the money or out of the money. So yesterday we have seen about the Black-Scholes-Merton model. So there so basically this outputs, for example, we get it as an output once we feed those basic attributes into the engine. We get the outputs like delta, gamma, theta, vega, rho, so as an output. But predominantly what these measures mean and what it signifies from the exam perspective, it's an highly testable concept. So let's see one by one. I will try to cover delta in this session because we'll see everything in the precise way instead of rushing it through at one session. So coming to delta, so delta, for example, we call delta for options as an asset class, or fixed income. For fixed income we call it as duration. So what does delta conveys? So delta measures how much a portfolio, for example, delta measures how much the option price will change for a $1 move in the underlying. Say for example, you have bought a call option or a put option on the Apple stock. So if the stock price is making a move of $1, your option will not gain by $1. If it is an in the money call option, you will not make $1. You will make less than that or more. Definitely it is not more than that, more than 1, because the delta of options range from 0 to 1. So if the stock is moving by 100%, you will gain close to 100%, not more than 100%. So the delta will range between 0 to 100%. What I mean by 0 to 100%, you can gain from 0% or 50% or 60%. Say if the stock is gaining 10 rupee in a day, you can make either $6 on the call option or $10 on the call option, not more than $10. Okay, so what does this delta helps in pricing the options? Say for example, you have taken the position on an option. Say for coming back to an example, so this is the put option scenario analysis chart. So you can see the range of stock prices on the on this area. So this is the put options stock prices, stock levels I mean. So these are all the deltas of the options. I would say these are all the deltas of these options. As you can see, these deltas are ranging from 0.32 to 0.68. So this is specifically the put option. As you all know, the put option is said to be in the money when the strike price is more than the stock price. So where do the stock price currently at? The stock is currently at 50, and say for example, if you have taken the strike of 52, your delta is more. Your delta is 0.68, and if it is 48, say if it is an out of the money option, the delta is 0.32. So what does this 0.32, 0.40, 0.50 or 0.68 conveys is, so if the stock is moving by $1, if you have taken the strike of 52 when the stock is at 50, if the stock is moving $1 on the downside, you will be gaining 0.68 cents in the option side. So that is what it actually signifies. So how much an option will gain if a $1 move in the underlying. So we are making 68 cents. Now you can see on the out the money side, out the money strike. Say for example, if it is a 48 strike, you can see the delta is 0.32. So in this case, if the stock is falling down by $1, you will be gaining only 0.32 cents. So the reason is those are probabilities. If the stock is 50, and if you have taken a put option of 48, so which is out of the money, I would say. Why it is out of the money? The reason is the strike price is less than the stock price. The stock price is already above the strike. So you are saying that stock will fall below 48, but the stock now is already above 48. So for you to break even, so the stock has to reach the levels of 48 and then it has to fall below that to make profits. So that's the reason the delta is 0.32. I mean to say that you will gain less. So in case of in the money options, that is the strike 52, here you can see the delta is 0.68. So what does that it conveys? So if it is moving $1 on the downside, you will be making more. Why it is making more? The reason is the stock your strike is already more than the stock price. So the probability that your option is expiring in the money is high because your exercise price is high. So basically, to put it in a simpler way, this option is a 60 days from expiry. So here 60 days from expiry. So what we are saying is after 60 days I'll be selling the stock at 52. So if you are buying the put option at 52, what does it conveys? You will be selling the option at $52. That is the actual reason. But now you can see the stock price is close to $50. So that's the reason the delta is on the higher side, since it is an in the money options. So delta predominantly ranges between 0 to 1. So in case of put options, it is from 0 to -1. So in this case, you can see when the strikes are more in the money, you can see the deltas approaching close to 1. This is the basic explanation behind the delta factors. So now coming to the gamma factor. So what does gamma measures? So gamma measures how much the delta will change. So the first factor, the first order derivative, actually measures how much the option price will change if the stock price is moving down by $1. So but we need some other factor to measure how much the delta will change if the stock price is moving $1, because this delta, since it is ranging from 0 to 1, it has to change. Say in case of this option, the delta is 0.32. Once the stock falls below 48, say for example if the stock is going to 40, the delta will not be 0.32, it will be more than that. The reason is your option is already in the money. So when it is already in the money, so your delta should be close than 1. I am not saying it is perfectly 1, it will be close to 1. So that's the reason we need gamma factor to measure how much the delta will change if the stock price is moving up down by $1. So this is the most predominantly we can say gamma is the second order derivative, delta is the first order derivative. So in case of fixed income products, delta we there call it as duration, and gamma we call it as convexity. This is a simple thing. So duration and convexity will I assume all you know, we'll explain in another session. As of now, delta and gamma are the predominant factors. From exam perspective, what is the areas which you should know? So what is most important and what is most significant? Say for example, either FRM or CFA, they likes to play around the deltas. Say for example, they can test on, say for example, if your stock price is 100 and at the expiry and the underlying price is 90, what will be the delta? So what will be the delta of your option? So if you have bought the call option, or if they might give you the delta, say for example the delta is 0.5 and the strike is 100 and the stock price is 110, how much you would have made on the call option front. It's a simple 10 into 0.5, it's a $5 move. So that's how they do on the testing side. So deltas for call option range from 0 to 1, for put option 0 to -1. So predominantly it's more or less the same. So for call, the delta measures on the upside. I mean to say, if the stock is moving on the upside, how much our call option will gain. On put, it's on the downside measure. So if the stock is moving down by down, how much our put option will be gaining. So this deltas are not constant. These deltas will be changing. The reason is, in markets we have various strikes. We have various strikes which we are going to bet on the exercise, which are more than option price. To say more than the stock price, which we call the out of the money options, and we have strikes which are less than stock price, which we have called in the money option in case of call side. So that is the basic explanation behind that. So this deltas, say for example, this deltas will be ranging from 0 to 1 if it is an out of the money option. The deltas will be predominantly less, and if it is an in the money option, delta will be predominantly 1, and it behaves more or less like an underlying. So for the call option front, and on the put option side, the deltas range from 0 to -1. But one basic difference between the call and put option deltas is the deltas of put option are less. The deltas of in the money put options are comparatively less than deltas of call option. The reason is that the stock price cannot fall below 0, but the stock price can go to 0 to 1000. So that's the reason we have a lower bound. So our deltas are always less for deep in the money option. Say for example, if a